Welcome back. We are just halfway through the earnings season, and so far we're seeing an extension of the same themes that drove the last few earnings seasons, namely falling earnings and sales, a weak energy sector, and a strong U.S. dollar. So with little or no growth in sight for many companies, where should investors look for any opportunities? Joining me, Damian Fernandes. He is portfolio manager for the TD Balanced Growth Fund. It is great to have you here. How are you?
Thanks, Kim. It's great to be here.
Okay, let's talk a bit about these earnings. I have to say, someone who's been watching earnings for a long time. It's exciting times because there's some really interesting,
volatile and exciting times.
Yeah, you're seeing a lot of interesting things. What are you seeing just overall in terms of thematically from companies that are reporting right now?
Kim, it's been a few times we've come on the show and we've talked, and I really am sounding like a broken record.
It's okay.
Because the last few quarters, it's been this sequential themes where we've had slowing top line growth. So, for example, this quarter, so far this earnings season, about half the companies have reported. You're looking at the top line slowing by about 3%.
Yeah.
This quarter is kind of anomalous because for the first time, even if you exclude energy, we actually are having negative earnings. So the top line slowing, you're having margin pressure, so earnings for this quarter are expected to be down about 5%. Even if you exclude energy. Before, if you excluded energy, you're looking at least some positive earnings growth. Now it's the whole market is being dragged down. And there are a few things. It is the strong US dollar, but more importantly, it's what you see. It is slower global growth.
Yeah. I want to get into some charts that you've brought here because I think they're fascinating in terms of what you're looking for, the types of companies that are interesting right now. So I think let's bring up the non-cyclical chart right now. You've got non-cyclical and cyclicals, and what's interesting within those buckets. So we bring up the non-cyclical here. You've got basically broken up into fast growth on the top left, or the top here we can see, and then slow growth on the bottom. Just tell me a bit about what we're looking at here and what's interesting.
So the main thing that we're looking at is that in this marketplace, what you're really being rewarded for is consistency.
Yeah.
Or if you are a secular grower. So what you're seeing is high quality companies that have defendable franchises, that have a good earnings stream, as opposed to ones that are being challenged. So in that top left-hand corner, I have what I'll call secular growers. So that's, for example, biotech. We have a company that we own across portfolios, Gilead. Mm-hmm. It reported today. Gilead reported that its earnings were up $12.60. That's up 56%.
Wow.
Year on year. This company trades sub 10 times PE. It's right now it's benefiting from a drug, but that's my point. It has a clear path to earnings, and the stock was up 4%. So we have names like that. In that chart too, and we have what we'll call, in secular growers, we have new technology. That's for a name like Google, where search was up 26%. Mm-hmm. So in a market where advertising is challenged and global growth is 3%, you're having a top line for a mega cap up 26%.
Yeah, and the nice thing with them too is they've got to break out what they call the moonshot companies this time too. So you actually get to see what driverless cars lose a ton of money, but search still does pretty well.
They are losing a lot of money, but the market is valuing the core business, which is still where the actual enterprise value of the company is. All of the value in the company is in search. And for example, just maybe as an aside, Google and Facebook, when you think about these two companies, they're really collectively taking all the ad spend that used to go into print media, that used to go into television. These are the two.
All my media colleagues tell me that, yes.
When I think about it, Google and Facebook will never call themselves monopolies, but Facebook is a monopoly in social media. Google is a monopoly in search. So these are tremendous businesses, and they are like there is no competition right now. So all of those ad dollars that were going to the old media are now just congested in these two companies. That's why you see the top line acceleration. Yeah,
and then you see the actual complete opposite for those other ones you're talking about now. So let's talk about the other side, the other chart here. So those are the non-cyclicals. Let's look at the cyclicals here. And again, we're seeing secular growth at the top here.
Sure. Autos,
airlines, housing-related, WestJet being a big exception on the airlines piece, I guess.
Yeah, in favor cyclicals are, for example, look, in airlines is an interesting space because global growth, travel is still growing, and it's particularly a lot of that demand is coming from emerging markets. So even when you look at China, yes, the manufacturing side is decelerating, the industrial side, but consumption is actually growing quite nicely in China. More people want to travel. Planes benefit. So companies like Boeing, Airbus, which have an oligopoly on plane manufacturing, are benefiting. Airlines, their biggest input cost is fuel. They're seeing tremendous returns in this marketplace because they've just seen their biggest cost get shaved down by 2/3.
Yeah. So it's a big move for them as well. Let's get into some names that you like. So that's kind of like, that's how you look at things, the big picture. And you've mentioned a couple, but we'll go through them. Microsoft is one that you think is interesting. Now, why Microsoft?
Well, when we think about names we like in this environment, and I'm almost repeating what Bill said earlier, you really want what I'll call durable franchises.
Yeah.
And Microsoft is a tremendous franchise because it has its core software business that's still growing, mid-single digits. This is, the Office applications and Windows. But then you also have the Azure business, which is its cloud business. I've talked about this before. That's growing 140% year on year. A tremendous thing as companies move away from traditional databases and traditional software to moving into the cloud. Microsoft is a natural partner in this. The thing when I think about these businesses too, we talked about Gilead, we talked about Microsoft, is that all these businesses are have very strong balance sheets. And right now what we're seeing is that credit contagion, so credit stress that was coming from the energy sector is actually impacting other sectors.
Yep.
So what you want what I'll call, bulletproof balance sheets.
Yep.
And these companies have it. And the last time I checked today, the 10-year in the US was trading sub 2%.
Yeah.
Microsoft yields you 2.6. It's growing its dividend double digits. Gilead is yielding you 2.1. It just raised its dividend 10%. McDonald's, that we can talk about.
Yeah, let's talk about, because McDonald's is another one you like right now, yeah.
Yeah, all of these, what these companies have in common is that they're big franchises that have a clear path to stable earnings growth. In a volatile world, investors will pay up for this predictability.
What about though, so I just want to run so people know, so the companies that you like and you own right now, Microsoft, Google, McDonald's, Gilead, there's a few others which we may get time to, but the one thing I guess, aren't they expensive? Because you have this thing where, you're right, it's strong balance sheet, they're bulletproof, they've got a clear growth path, and right now they're stable in what is a very, but everyone is flocking to those, so is there concern about valuation?
The concern, look, I think the concern about valuation for these stocks will end until global growth accelerates.
Yeah.
Until we're going through this, we're meandering through this very slow growth environment where there's massive uncertainty in companies' profiles. I'll give you an example. The S&P this year, analysts were expecting the S&P to generate you $130 in earnings. And December, this is what they thought the S&P would do at the end of the year. We're literally 6 weeks in, and that number as of today is 123. Right? So if I put a 15 multiple on 123, we're kind of where the market is. It's not, the problem is these companies that look artificially cheap have earnings risk.
Like what? What would be artificially cheap?
The artificially cheap would be right now I think the oil and gas companies still haven't marked down to the current strip prices. I know Bill was on earlier. There's a lot of artificial cheaps where the PE multiples are not marked to market to the actual earnings that these companies will generate. I think investors will continue moving towards these quality growth companies just in this uncertain environment. When will the risk premium that these companies enjoy come out? When we have some clarity on the global growth environment. I don't see that anytime soon.
Yeah.
I'm sorry to be blunt about that.
I think you're telling people what they need to know. I should mention the strong U.S. dollar. That's one thing that all these companies have to deal with. Is that something that's going to abate in a little while, just in 10 seconds or less?
Strong U.S. dollar. So right now, the U.S. dollar has appreciated 12% year on year. It's very hard if the interest rate hikes for the Fed have been removed this year. I think there's now a 12% chance of one rate hike for the year.
Yeah.
I would be hard pressed to see the U.S. dollar continue its torrential, pace it has enjoyed.
Damian, always a pleasure. Thanks so much.
Perfect. Thank you, Kim.
Damian Fernandes, Portfolio Manager with TD Balanced Growth Fund. That is it for us tonight.